Okay, here we go. We are going to do our first class on the basics, the very basics of penny stocks and just stock market in general. If you are like what I would consider an intermediate to an advanced student, this class is going to be slightly remedial for you because I'm doing this under the pretenses that you have no idea that the person watching this doesn't understand anything, have the slightest clue about what penny stocks are, the stock market in general. So I'm kind of doing some basic understanding. This is like the 101 class, if you will, just to lay the foundation. Okay, this is me. Your host is Mark Jackson. It's been someone who's been trading for a while, and I've done options trading, forex trading, regular day trading with a gap system. I've done a lot. I've been through a lot of different classes, and this has been years in the making. And anyhow, I just kind of found something that I think really is very opportunistic and profitable for those who are willing to learn and those who are willing to put in the time. And it doesn't require a ton of capital. And that's the number one reason why I'm into this, is because you can teach some people who can take literally about $500 to $1,000, and you can really begin. Once you learn what to do, you can really become, you can change your economic outcome, and that's the whole purpose. So this is volume one of a, I don't know, I think it's about a 10 disc series that's going to be coming, and it's going to just give you the basics. So let's go ahead and get started. And I asked this in question format, and the basic question for someone getting started would be, well, what is the stock market, right? And so the stock market, as it states here, is nothing more than a collection of markets and exchanges where regular activities of buying, selling, and issuance of shares of publicly held companies take place. Okay, so that's the official definition. Let me make it simple for you. Let's say a company like Starbucks. Starbucks is a publicly traded company, and it's traded on the New York Stock Exchange. Okay, Starbucks essentially can sell shares of ownership, and they do this because they want to make money, so they can of course continue to put out wonderful products or whatever it is they do, right? And so they can sell shares of the company to investors who are willing to invest in Starbucks, and investors will then of course pay whatever that dollar amount that they see valuable for that particular stock. So let's say Starbucks is selling for $50 a share. So for each share that you purchase from Starbucks, you're going to pay $50. Okay, this all takes place at the stock market. Okay, and there's several exchanges that we need to know about. There's the New York Stock Exchange. Okay, this is kind of the big one. The National Association of Securities, also known as NASDAQ, that's a digital index. And then there's the Chicago Board Options Exchange, CBOE, which is based out of course, Chicago. This is dealing with options, okay? And then there's the OTC market, also known as the over-the-counter market, okay? There's also the pink sheets, but I don't trade pink sheets, okay? I'm just kind of giving you a basic rundown so you understand what exchanges exist. These are the locations that you have to go, whether physically or digitally, depending on which one, in order to purchase stock from the companies that would be on these exchanges. Okay, so that's what the stock market is. It's a collection of markets where different companies, Starbucks, Nike, McDonald's, Walmart, Target, you name it, there's a ticker symbol for it. This is where they go to allow you, the general public, to purchase their stock. Okay. So what is stock? Okay. So the official version is stock is generally referred to as a share or an equity. It is a type of security that basically signifies a proportionate ownership in the issuing of company or a corporation. So essentially, when you buy stock into a company, we'll take Starbucks again. When you buy stock in Starbucks, essentially what you've done is you bought some ownership. You've invested ownership. Now, do you own the company? No, but you own the shares that you purchased, okay, and owning the shares that you purchased. Let's say you purchased Starbucks at $50 a share, okay. If the stock of Starbucks goes up to $60 a share, you've just made $10 a share. So that means you've made a return on your investment. So essentially, stock is basically a way that companies get you, the public, to invest in them so they can, of course, grow their vision of whatever their company is that they're trying to build, right? And so you buy ownership in it, and you are willing to do that because you think this is a valuable company that is going to go up in the near future or in the future in general. And because of that, you're willing, if you will, to purchase, to spend your hard-earned money on that. So that's what stock is, okay? And then the next thing is what's a ticker or stock symbol. Each company has a ticker system, okay, a symbol. Let me say a ticker symbol. And so what you have here is, like, for the company Starbucks on the market, is traded as SBUX, okay, and so SBUX, you put in that basically acronym, and that is the representative symbol in the stock market for the company Starbucks, and you can find out how many shares that company may be worth because of it. So, for example, since I actually can go in and out, let's jump over here to stocks to trade, and I'll put in SBUX Starbucks, and boom, voila, it'll take us to Starbucks. And this is pre-market. Let me move it forward. Do I have that wrong? I do. I apologize. I'm going to just switch this over to the cursor. And this will allow you to see, what Starbucks is doing. But what we can see here is Starbucks is valued at $88.90 a share, which is that's phenomenal, because I can recall maybe 3 or 4 years ago that was at $54 a share. Okay, so that means that it's constantly gone up. So essentially, you can put in a ticker symbol. We had Target as another example. Let me put in TGT. And it'll take us over there so we can see. There it is. Target is worth $124 a share, which is interesting because I want to say 3 to 4 years ago, that was in the $70s or $80 range. So you can see that these companies over time, especially these very strong fortified companies, make money, right? And so essentially, these are the stock that they're selling the stock because, of course, the more investment that they get, the more that they can expand their operation. That's the whole point of all of this business, right? And capitalism. So when we see tickers, what you see at the back of the screen, Ford, the ticker symbol for it is F. GE, General Electric, there it is right there. GE, Fitbit is Fit, GoPro, GPRO. You get it, right? So you can see these different Disney. You see these different ticker symbols that represent these different companies. Okay, so that's how you say, hey, I'm interested in Nike, and you put in NKE. You find out what Nike's worth. If you think that it's worth that much, then and if you're willing, then you can purchase shares in the company. Okay, so that's kind of what that's about. So that's what common stock is. Okay, it's just basically shares which you can purchase in as an equity, or if not, just a share in a particular company. Okay. All right. Well, this course is about penny stocking. So what is a penny stock? Okay. So I'm gonna always give you the official definitions, and then I'm gonna make it make sense to you in layman terms if need be. Okay, but it simply states here that a penny stock refers to a small company stock that trades for basically $5 or less. Okay, so many penny stocks are listed on the large exchange, like the New York Stock Exchange. The other stocks will be found in the OTC market. So you have some stocks that are under $5 that are what we refer to as listed stocks, and they trade, of course, on the New York Stock Exchange, NASDAQ as well. Then you have some that are not listed. They are on the OTC market or the pink sheets. Okay, and so essentially you can see that penny stocks can fall under a couple of different exchanges, but the key to remember is if it's less than $5 a share, it's considered a penny stock. And other things that you can use as your guide is the fact that you have this micro cap. Usually penny stocks will be fall into the micro cap and a small cap not time frame, but micro cap and a small cap frame. And what that means is we see here microcap is a publicly traded company that has a market capitalization of between 50 million and 300 million. So what they're saying is its market cap, its net worth basically is in between the 50 million and 300 million range. That's what a microcap is, which falls under most penny stocks. In addition to that, a small cap is basically the same thing, but its market capitalization is between 300 million and 2 billion. Okay, so most penny stocks will fall in this range, right? And so I'm not trying to get into all the other bigger stuff because literally I really am I'm tunnel vision with what I like to do. I focus on what you need to know to understand what we are doing here, which is penny stocks. If you want to know all that other stuff, then you're gonna have to go elsewhere, do some more research. That's fine by me, but I I got tunnel vision when I know something is successful. I just stick to that, okay? Because that's the best way to do it, in my opinion. All right, here we go. Okay, so we know what the stock market is. We know what stock is. We know what the penny stock is. We know what the different exchanges that exist. What is trading? What's a trade or trading? Okay, so the official definition of trade is a basic economic concept involving the buying and selling of goods and services, with compensation paid to the buyer, by a buyer to a seller, or the exchange of goods and services between parties. Okay, so essentially, if you were trading something, let's talk about Starbucks again. Okay, when you actually go to Starbucks, you go there because you value their coffee, right? And you trade your hard-earned money for a cup of coffee, right? That's a trade. It's a purchase. It's a trade. It's compensation. You compensate them with the money that they said that they think it's worth, and then they compensate you with the drink, right? So essentially, the stock market is essentially the same thing, but just dealing with basically stock and contracts. So essentially what you're doing when you go trade Starbucks, instead of trading your money for a coffee, you're trading your money for investment into the company, okay, at a certain dollar value that you deem viable, right? So you say, oh, I think Starbucks, I can't remember the number. I think we said it was $88. I can't remember what Starbucks was. But let's say Starbucks is $88 a share. And if you think that's fine, then you buy it. And if you don't, then you say, nah, I'll wait till it goes down because I think it's a little overvalued and I think I can get it at a cheaper price, like you want it on sale, essentially. Okay, so essentially the bottom line is a trade is when you are buying stock of a company because you see value in it at that particular time. Okay, just to go along with this, this is all based off of capitalism, okay, which is it states an economic system which people or companies set the market economy through supply and demand. So it's very simple, okay. When you buy something, you actually set the market. If you think something is valuable enough, like let's use an example, like the shoes, the Jordans, okay. You know, I would imagine the average pair of Jordans go for like $250. If you, the consumer, believes that Jordans are worth $250, then you pay $250 for them. And if there's not enough Jordans in supply, they'll raise the price. Okay, because there's more demand than there is supply, so it's going to drive the price up. But let's say you say, Jordans for $250, that don't make no sense to me. I'm not paying that. Well, if the planet decided that they wasn't gonna pay $250 for Jordans, what is Nike gonna have to do? They're gonna drop the price because they have all of these shoes. They got a whole bunch of supply and no demand. Nobody wants to buy it. So the only way that they can entice you to buy it is if they drop the price. So in capitalism, the consumer truly sets the price if they band together. If the consumer don't band together, then it becomes problematic. But that's a whole nother topic for a whole nother time. I'm just trying to give you the example and help you understand that this whole stock market works off capitalism, in which the price is set by the value, and value is set for multiple reasons. Why Jordans are worth 300, I have no idea, but I do know people who will pay that kind of money for some shoes that don't cook, that don't clean, that don't do nothing that you need functional in your life. So you can probably guess that I'm not buying no Jordans for that kind of money because that don't make no sense to me. It doesn't have value to me, but to somebody else, they will be more than willing to pay that price. So you get the point. All right. Supply and demand. This is just basic economics, man. When there is a whole lot of supply and not enough demand, prices go down. Okay. So if the stock is at $88, like Starbucks we were talking about, but nobody wants to buy it and there's no value, price will slowly begin to drop down because people will become concerned that no one values it that way. And so the people who do own shares, they might start to let those shares go. And as the price drops down, okay, when people say, oh, that's the price I wanted, and the demand picks up, okay, and there's not much supply, then the price goes back up, okay. So the bottom line is supply is when we have too much supply, price goes down. Too much demand, price goes up. Okay, or not enough supply, but everybody wants it, price goes up. Okay, so just let's imagine it this way. Okay, there's only 2 seats on the last flight home, and you were like wherever you're at, you're halfway around the world, and essentially there's 5 people who need that seat. Well, if you're the airline company and you know that there's only 2 seats and 5 people need it, there's more demand than there is supply at this point in time. So you can jack the price up on them seats so you can make some more money. Okay, so you get the point. All right, I'm not going to beat a dead horse, but you should understand supply and demand by now. All right, here we go. What's next? Okay, the types of traders. Okay, this is all just basics. I'm just giving you very basic stuff. Okay, but there's several different types of traders. There is the day trader. Okay, and as it states, a day trader is a trader who executes a large volume of short and long trades to capitalize on intraday market price action. Day traders use technical analysis. We're going to talk about technical analysis in a little bit. Let's go to a chart. Okay, this is Sava, S-A-V-A. This is a stock literally just last weekend that just jumped off of the charts. We see it went from $7 to $11 between noon, because this is mine is West Coast time, but 9 a.m. equals noon on the East Coast to close. Okay, so from 9 to 11, which would be noon to 2? This thing went from $7 to $11. That's kind of crazy. Only if you're not used to penny stocks. Penny stocks are volatile. That's why I like them. And they have these huge price increases when there's volume, which all of those terms that I'm using, we're going to talk about later. I'm just getting you to understand the basics. The most important thing that I want to pull your attention to is this time frame right here. This is the stock that we're looking at. The chart is SAVA, Cassava Sciences, and this is the 5-minute chart, which means every candle you see, these are referred to as candlesticks. Don't worry if you don't know what that means. I'm going to teach you in due time. Okay. Actually, I think that's the next lesson. But anyhow, every one of these candles represent 5 minutes. So what we would refer to this as a intraday chart. So don't forget, we said day traders execute large and short. They execute long and short trades off intraday price action. So a day trader would be looking at price action. They would refer to this as, look at this area down here. This looks like a great area because if it breaks out, we don't know where it can go, but it's going to run up pretty good here. This is another area that a day trader would say, wow, man, this stock, prior to you seeing this happen, this stock can break out again. I'm a buyer if it pushes this area. Okay. And so essentially a day trader will get in. Let's just say the day trader got in right here. Okay. At noon at $7.11. And when this stock rose up $2, let's say they say, wow, I just made $2 a share. I'm extremely happy with this trade. I'm going to now sell and close this trade. And they do all of that in the same day. When you open a trade and close a trade in the same day, that is considered a day trade. Okay. And so there are people who make a living simply by day trading. I am one of those people. Okay. So that's what a day trader is. Okay. Let me go. Oh, look at this. back. All right, swing traders. Okay, let's look at what a swing trader is. Trader number 2. A trading style that attempts to capture the gains in a stock over a period of a few days to a couple of weeks. So let me give you an example. Let's go to the chart again. Now, this is the same company. The difference is the time frame. This is the daily chart. Every candle you see here represents one day, which is why this goes from January all the way back to April. Okay, a swing trader might recognize right here, okay, right in this range here, this $2 range. And by the way, I want you to think about this. This stock was on, what is this, probably December, let's just say mid-December, because I can't see that the days are not popping up, but we'll say mid-December. Mid-December, this stock was at basically $1.80. And as of Friday's close, which would be January 3rd, I want to say, this stock went to $11. That's just phenomenal gains. And that's the beauty of penny stocks. This is one of the reasons why I like them. Okay. But anyway, let's say you were able to recognize that, man, this is a great opportunity right here. This is going to break out. Okay. And you bought this and you said, I'm going to hold this for a couple days to a couple of weeks because I want to see how far this can go. So a person who entered this trade, let's say on this date, let's just call this date December 17th, okay, and held that stock and held that trade up until, let's say, January 3rd, that would be considered a swing trade because they held it for 2 days or more, usually 2 days to a couple of weeks, okay. That's a swing trade, okay. So that's another form of a trader. Swing traders don't necessarily, they don't operate like day traders do, but they do use the same form of analysis, okay. I just want to make sure that you understand that there is a difference between somebody who took a trade on the 17th and then closed it on the 3rd, as opposed to somebody who got in the trade on the same day and closed it the same day. There's a huge difference, okay. Let's talk about options traders. I'm actually not going to spend much energy on this. I just want you to know that options is a strategy. I don't teach options. There are many people on the planet who do if you're interested, but just understand that options, it's like you have the, okay, it gives you the right but not the obligation to acquire a stock, you know, through a predetermined price. Options can be a little more complicated because it has several entities that weigh in on it. And that's why I don't talk about it, because, you know, I know how to trade options. It's not my cup of tea, and I'm not talking about that nor teaching that here, so it don't matter. But I just want you to know that these people exist. And then the last type of trader there is that I want to talk about at least is the buy and hold trader. Okay, what is a buyer and hold trader? It's a passive investment trader who buys stocks or other forms of securities and holds them for long amounts of time regardless of the market, okay, fluctuations. So let me give you an example of that. This is the swing trader. Here we go. We're still on the daily. We're on Starbucks. Okay, we're still on the daily chart. But somebody who's a buy and hold type of a trader, let's go all the way back here to April. Let's say that person on April the 1st said, you know, I just really believe in Starbucks. I'm just going to buy it and I'm going to hold it. I don't care how it fluctuates. Okay. So a buy and hold person will buy this stock and just hold it sometimes for months, most times for years, because they understand this is a very good, like, rooted company with a very strong foundation and that it's never going anywhere. Okay, think about how long Targets have been in existence since you've been alive, right? Think how long Walmart, which is actually still relatively young, but it's been around. Okay, or McDonald's for that matter. Could you imagine if you bought McDonald's 25 years ago and you just held it? You would be very wealthy. This is the buy and hold tactic, right? And so you buy here, and when we talk about fluctuations, see, this is a fluctuation. It pulled back, but then it boom bounced up, and it pulled back, and then boom bounced up, and we can see it really pulled back over here. The point is, buy and holders, they'll hold the stock. They're not worried about the fluctuations. This is a 15, 20-year game for them. They've done the research. They know this company is going to be around. They're not concerned. Okay, so those are the different type of traders you have. I'll fall in that penny, that day trader. And most people who would take this class would fall in that realm because that's what we're doing. Okay. All right. So let's talk about the different types of analysis. There's two key forms of analysis. Okay. There is fundamental analysis and there's technical analysis. Fundamental analysis. Okay. As it states, is a method used to evaluate a company's value by examining related economic and financial factors. Fundamental analysis study anything that can affect the stock's value, such as the state of the economy, the industry, conditions, and company management, to name it. These are just a few factors, okay? So when somebody is a fundamental analysis, they want to look at all aspects of that company. They also want to look at the market and the industry, what's going on the planet at that particular time. And these are going to all weigh heavily into their decisions to buy. Usually fundamental analysis traders are going to usually be buy and hold type of traders, option type of traders, and also swings. But you got to understand that some people use both fundamental and technical analysis. There's no one who solely does, well, I wouldn't say that. There are people who solely do one or the other, but most people blend them. It's kind of hard to not blend them, especially if you look to hold for longer terms, okay? Other terms that come along, you don't have to know these terms, but other terms that come along with fundamental analysis is PE ratio, revenue, and then earnings per share. PE ratio is this price to earning ratio. It's basically a calculatory deal where they can basically evaluate a company's value by calculating the prices to its per share earnings. This is when things get a little bit complicated and deep, but it's not as deep as you think. You just got to read. You just got to spend some time and study. Revenue, we all know what revenue is. Basically, the bottom line is what did you make after subtracting all costs and all the other things. Okay, and then earnings per share. Earnings per share is important. And fundamentals. Okay, all these things help you create a value for a company and decide whether you will buy this company at its current share price. Okay, that's all that basically is. All right, technical analysis. This is what I use. This is what almost every day trader is using. Most day traders, even they use, depending on what type of day trader you are. I only buy. I never short. Which is in two terms that you'll understand in the next video. But the bottom line is some technical analysis use, some technical traders use both fundamentals because they can use fundamental information as part of the reason why they might short the stock. That's neither here nor there. Okay, so technical analysis, a trading discipline employed to evaluate investments and identify trading opportunities by analyzing statistical trends gathered from trading activity, price activity, and volume. Okay, so technical analysis focus on chart patterns, price action, and other indicators to evaluate a security's strength. Security is nothing more than a stock, strength, or weakness. Okay, you just got to understand the language, right? That's why we're doing this. When you hear the term security, it's just another way of saying stock. Okay, I want to make sure you understand that. So what does all this mean? Because sometimes people get lost. Bottom line, if you're a technical analysis, technical trader, you basically are using the chart to make your decision. You're not worried about the PE ratio. You're not worried about what the company's revenue is on the year. You're not worried about any of that data. You're looking at the chart to recognize chart patterns and to recognize price activity and to recognize volume. And you're using those as your guide as to why you make a decision on whether you will buy this particular stock or not. So most technical traders are day traders. This technical analysis is for day traders. Okay, so you need to understand the difference between the two. If you're more into fundamentals, you're more of a long-term trader. If you are more into technicals, you are a short-term trader who plan to make open and close the trade all in the same day. Okay, very important that we understand that. Okay, and I'm gonna go to the chart. Let me see. Okay, I'm going to give you one example real quick because I was just looking at a chart. We had Saba pulled up. All right, 15 minutes. Okay, so a technical trader is going to have a couple indicators. These things, these lines you see here, those are called moving averages. We're going to talk about those in the upcoming class. But they see patterns. This is a breakout pattern. Okay, this is a pullback pattern. They see things and they watch price action and they say, yeah, if price pulls back into this area here because it's got former support, I will buy it here, right? And this is why you see the stocks, they'll pull back and then boom, they bounce and you don't know why. Well, if you understand how to read a chart, you'll understand it, okay? In charts, stocks can only do three things anyway. It either goes up, it goes down, or it goes sideways. Those are the only three things that it could do. Okay, so what you are doing with technical analysis is understanding why it's going up, okay, or understanding a pattern that might give you reason to believe that this is a good opportunity. Okay, so that's what technical analysis does. You are evaluating the chart. You don't see a PE ratio over here. You don't see revenues on this chart. You don't see none of that information. What you see is nothing more than a chart and a candlestick representation and how it may be fluctuating, how price is moving. Okay, so these green candlesticks, I'm sure you guessed it by now, means price is going up. Okay, and these red candlesticks means price is going down. Okay, so it's really simple, but technical analysis is evaluating the chart and letting the chart allow you to make the best decision on what you are going to do with this next trade. Okay, let's get back here. Present. Okay. All right, so we talked about that. Okay, here we go. How can you benefit from trading, excuse me, penny stocks? Okay. All right. Number one, with the right education, understanding, and strategy, trading penny stocks can change literally the economic outcome of your life. Okay. Penny stocks are great for the little guy. You know, most people, when you hear people trading in the stock market, you think hundreds of thousands, you think big money, and it does. I mean, there is some big money moving, trillions of dollars moving in and out of the market every day. Um, and you would be under the pretense that you got to have big money to be able to participate. I used to believe that all the time, and then I found out about penny stocks, and I ain't even talking about OTCs. I'm talking about listed penny stocks that are, that trade much like the big boys do. You begin to realize like, oh wow, there's a ton of opportunity and I don't have to have a lot of capital to get in and get started. Okay. Um, is trading penny stocks risky? This is kind of a common. Most people would say penny stocks. Oh my God, don't trade penny. Most people say you don't trade penny stocks. They're too volatile. They're too unpredictable. They're not regulated, and that's not true. Some of that is not true. They are volatile, true. They are regulated. Some people say they're not, but they are regulated. They're regulated by the SEC. Okay, they you want the volatility. Okay, you want certain things because it goes back to number one with the proper education, understanding, and strategy. Okay, you need to know what you're doing. So, of course, my answer to that would be trading anything is risky without proper education, preparation, and execution. If you're not properly educated on the decisions you're going to make as to why, this is the funniest thing. I've talked to a bunch of different traders. Okay, I've listened to a ton of horror stories, and I'm talking whether it be penny stocks, options, or regular stocks. Okay, and most people cannot tell you why they are taking a trade. They're just being very impulsive and taking it because of the opportunity of making money. Okay, well, if there is an opportunity to make money, there's also the opportunity to lose money. Okay, and you're going to lose trades. Make no mistake, no one has a perfect batting average. But the point is, if you don't know why, if you don't have the proper education, if you're not prepared, then how in the heck are you going to be good at this and execute and do things when you actually have the opportunities and the advantage to your side, So the biggest thing is anything, and I mean anything. Go place a bet in Vegas. That's risky. You know, any of that is risky. Without proper education, you're gonna lose. You're gonna lose your shirt. Okay, and that's just part of the process. Okay. Now, what is the advantage? Okay. There's a huge advantage to trading penny stocks when you understand. Okay. So when you're one educated, okay, um, and you're prepared and you know what to do and you have a strategy and you understand your strategy and you know why you're taking a trade, man, the upside is exponential. It's unbelievable what you can do in the stock market. It's unbelievable what I've seen done. Most people would tell you, let me go back to this. Most people would tell you that it's not possible. Let me go here to the Arrow Daily. It's not possible for a stock. Okay, back. There we go. It's not possible for a stock to spike from $7 to $11 in a day. Well, all of that is possible. This is a small miniature version. Let me see some other ones that I've seen lately of what can happen with the stock just ripping. Okay, here's a good example. Look at this. This is Rite Aid. It went from $10, $11, all the way up to $24 in a 1, 2, 3, 4, 5, 6 day period. Now we see it's in the process of pulling back. But most people would tell you that that's not possible. I'm trying to remember the one. There was a stock over the summer. I couldn't believe it. I could not believe my eyes. I seen the stock go from $3 to $24 in one day. That's unbelievable. Okay, that's the type of stuff that happens in penny stocks. You can benefit from those when you're understanding. Look at this. I've been saying that term breakout. Look right here. This stock gapped right here to the breakout point, to the point that they could not break. They haven't been able to break this area for months, right? And all of a sudden it gets there. They call these or refer to these as multi-month breakouts. And look what it does. Gaps to 11 and off to the races. 11 to 24. Okay, that's beautiful if you understand and know what a breakout is, and if you prepared yourself to trade a breakout. Okay, if your education is on point and you're prepared and you meet opportunity, you know the best thing is gonna happen is some success. Okay, and so I say those things just to reiterate that with the proper education, man, you can do anything in this game. Anything can happen. And the best of all, as I state, you do not have to have a lot of capital. I can point you to exact traders, myself included, who started off with very minimal amounts of money, and over time. Now we're not talking overnight, man. If you're looking to get buku rich overnight, you're in the wrong location. You're in the wrong game. Most likely, if you think like that, you probably gonna get popped and you're gonna get broke. Because people get busted all the time because they want to just come in here and just throw some money on the table and say, "Oh, look, man, I made $100,000." That no, man. You just take your time, okay? You take your time and you work, and slowly but surely, man, you can increase your income. You can dramatically increase your income. And one of my favorite people that I use is kind of like my he's the trophy, if you will, on my wall of what I look up to be is a student by the name of Tim Grattani, who started this journey 8 years ago, I think, with $2,400 trading penny stocks, and then 9 years later, he's turned that $2,400 into $9 million. Now, that's impressive. If I told you that if you stay the course and you do these things and you master just this one technique, that in 3 years you'd be a millionaire, would you do it? And most of you would say, yeah. If I told you that in a year you can just at least increase your income by $25,000, would you do it? Most of you would say, yeah. And so the point is, this ain't no overnight. It's going to take a little bit of time, but you're starting with the basics. You just need to understand what these basic things are, and then we're going to move to the next class. And the next class is going to really get into how you evaluate charts. Oops, I want to go actually to the regular chart. how you evaluate charts. Okay. And so we're going to learn what all this stuff is that's going on in this chart. Okay. And then we're going to take that to the next step. It's going to literally be, I think, let me double check. I can look right now. How many volumes to this? There will be, there it is right there, roughly 10 to 12 volumes. All of them no more than 45 minutes to an hour. I never like to speak more than 45 minutes personally. Breaking all of this down so it's palatable, so you can say, okay, I learned this. If I didn't understand this, let me go back. Let me get the basics, and then let's move forward. But the key here that I want you to understand is I want us to take our time step by step, and I want you to understand the basics. We're going to move and build from one platform to the next, man, and we're gonna turn something out that's gonna be special when it's all said and done. And so, let's go ahead and wrap it up. I pretty much covered everything I wanted to cover. This is the last slide. I just want you to know that the upside is exponential. You can't put the limit on it, and that it doesn't take much, man. And so I'm all about the little guy and giving the little guy an opportunity, which is what anybody wants to make a run at it, right? And so we'll stop it there. I'll allow this one to render, and I'll get volume 2, which is entitled, let's see, optimal trading, how to read a chart. Okay, so we're gonna learn how to read a chart, what chart is, how to read it, patterns, all those type of things, how to use it, right? That's gonna be the volume 3. So we're gonna move right on through. Okay, that's how that's gonna work out. All right, I will see you on the other side.